Welcome back to episode 77 of the What Do We Do podcast. Today, I'm going to share my investing playbook to help you have financial success from now until the end of the year. So get your pen and paper, your tablet, and your laptop to take good notes. It's going to be a great show, so let's go.
Welcome to What Do We Do? A podcast discussing wealth management and financial planning featuring key leaders in our communities. Hosted by founder and CEO of Great Lakes Wealth, Dewey Stephan. Tune in to hear how you can plan for and live your best life.
Well, hey, everyone out there in YouTube land and podcast nation, thanks for tuning in to another episode of the What Do We Do podcast. On today's show, I'm sharing my investing playbook to help you invest for success for the rest of the year. And if you like our episodes and content, please hit the subscribe button, give us a like, leave a comment, share with friends and family, because as a team, together, everyone achieves more. To start with, as we always say, if you fail to plan, you plan to fail. And at Great Lakes Wealth, we use goals-based financial planning and outcome-based investment solutions to build portfolios for our clients that are either based on something like income now or income later, or perhaps even growth on your assets. Whatever it is, we need to know where we are now so you can build a successful portfolio for wherever it is that you want to go. So where are we now? Where is the economy? Where are interest rates? Where is the Fed? What is the latest on inflation and taxes? And what about all the different markets out there and all the different options that you have to invest right now? Once we determine all of this information, we will work the problem backwards. We will build a portfolio where we can start by putting all of our money in and then diversify after we make our initial decision. And after all of the chaos in 2022, we believe we have a very good footing for the rest of 2023. As they say, bonds are back, but more importantly, cash is now king again. Last year in 2022, cash was actually trash, where you could only find maybe 0.5% interest on your cash in a bank. Well, now savings accounts and money markets, if you know where to go and can talk to a firm like us at Great Lakes Wealth, you can earn as much as 5% on your money while you sit and wait. And that means liquid, that means safe, and that means 5%, which compared to last year at 0.5% is 10 times as much money. On $100,000, that's $5,000 in interest while you wait versus $500 in interest while you waited last year. This is a great place to have your money as you start to build your portfolio for this year. So in a world where the stock market is typically an 8% to 10% return, and that would be our goal, starting at a 5% default is a very respectable starting point. So I recommend that we take our entire amount of investment dollars and put it into a 5% money market and then evaluate all the different options are there. And that is a great place to start. So as we've said before, bonds are back. But we have what's called an inverted yield curve, and that means that you can make more interest in the short-term bonds than you can the long-term bonds. And a money market is nothing more than the shortest-term bond possible because it's day by day. And again, at a 5% money market, daily liquid and safe, that's a great place to start. Whereas if you want to buy some bonds, you can maybe get a 2-year treasury or CD, and that would be 4.8% currently. Maybe a 10-year treasury or CD, that would only be 4% currently. And check this out, a 30-year treasury or CD would only yield approximately 3.9% 5% interest APY right now. So would you prefer 10 years earning 4% on your money, or day by day earning 5% on your money? It doesn't make a lot of sense to go longer when you have the opportunity to stay shorter, earn more, and determine where additional opportunities would lie. So bottom line, cash currently is king. Are you investing for the next 4 to 6 days, 4 to 6 weeks, 4 to 6 months, or maybe 4 to 6 years or longer? Each one of these time frames will absolutely help determine what investments you should go into. For example, if you're only investing for 4 to 6 days or 4 to 6 weeks or even 4 to 6 months, I'd recommend that you leave that money in the money market or go find a short-term treasury or CD if the rate is higher than said money market. But if you're investing for 1 to 2 years, 2 to 4 years, or 4 to 6 years, or even longer, then please use today's playbook and build a fantastic long-term portfolio. Okay, so now that we have all of our money in the 5% money market and we want to determine what to do with it, what do? We also want to recognize what kind of debt is out there, because one of the byproducts of the Fed raising interest rates is a 5% money market. But the other byproduct is an interest rate on your credit cards or your floating debt that has gone up as well. So we need to deal with debt and maybe now delete bad debt. Particularly credit cards might have been 19.99% before, way too high. Now they're back up to those historic highs of 29.99%. So if you have 5% in the money market and you have a debt out there of 19%, maybe 29%, it doesn't take a rocket scientist or a mathematician to tell you to deal with that debt, pay off that debt, delete it. So take some of the 5% money market. So pay off those high interest credit cards or any other loans that you have out there. Maybe use the number 10% or higher on your interest rate on your debt and use that money in the money market to pay it off. Delete bad debt. As I've said before, what's the easiest way to make 29.99%? Pay off that 29.99% credit card. Okay, so after we've dealt with debt, we now want to recognize where we are with the economy and our own personal lives. We may be going into recession. We may lose our jobs. We might have this thing in the markets called a flash crash. So, as we've said before, it's important to have an emergency fund. 3 to 6 months of living expenses is standard, so that if something were to happen immediately, you have liquid cash to support you during those short-term turbulent times. And guess what? We just determined a minute ago to put all of our money into a liquid, safe money market. So let's take 3 to 6 months of our living expenses and pull it out of this big pile of the money market and set it into a little side. We'll call it the escrow account. And that'll be our emergency savings. Now we have 3 to 6 months of emergency savings in a liquid, safe account earning 5% interest. So what do? No pun intended, with the rest of the money? We're going to look at it as maybe a deck of playing cards where we've already said cash is king. So what would the jack be? We'll say the jack is real estate. So what would the queen be? We'll say the queen is gold and other commodities. And we've already said that cash is king. So what's the ace? Well, the ace in this environment are stocks, okay? And the interesting thing about stocks being the ace is that sometimes the ace is a 1 and sometimes the ace is an 11. And we believe right now with the stock market, that's exactly the environment we're in. Some stocks will be 1s, some stocks will be 11s. And so we really believe it's not a stock market currently, it's actually a market of individual stocks. Okay, so if we're talking about the jack and that's real estate, it's very important that we talk about real estate that has cash flow. We're not talking dirt deals. We're not talking about speculative real estate. We're talking about getting a cap rate. We're talking about getting a return. We're talking about cash flow. Interest on your investment. And in real estate, I think the target right now should be at least 8%, either in a dividend or on a total return of that real estate. And you could use a REIT, you could use real estate mutual funds, you could use all kinds of different real estate options. But again, use a target number of 8% and make sure that real estate has cash flow. Okay, on to the queen, which is gold and commodities. They say that gold is a great hedge against inflation, and commodities, I believe, we're in a super cycle. So when you're looking at commodities, it might be oil, it might be natural gas, it could certainly be fruits and vegetables, but all the commodities out there are either non-correlated or lowly correlated to the stock market. That will give diversification. And again, historically, in a challenging time of inflation, commodities do well. We've already determined that cash is king. So let's move right to the ace, and that would be the stock market. As we've said, some stocks will be winners and some stocks will be losers. So please reach out to your investment professional, contact us at Great Lakes Wealth, go and do your research to make sure that you have the right stocks for you based upon your personal investment goals and objectives. But in this environment, I'll give you some basics to consider for the stock market. Number one, dividends matter. That's also, again, cash flow. And you're talking about companies that have good, strong balance sheets that they can provide a dividend. That'll help during the turbulent times as we try to figure out where this economy will stabilize during this uncertain time. Next, sector allocation is key. There are 11 sectors to the S&P 500, and they all go in different directions and do different things. I believe in this environment, you want to focus on energy, materials, consumer staples, financials, and healthcare. And the big elephant in the room, and also the largest sector of the S&P, is technology. And I believe that we all need to underweight technology for the foreseeable future, at least the rest of this year, as they are sensitive to higher interest rates. They have a lot more volatility than the rest of the market. So when we're talking about technology, though, in the short term, not now. In the long term, absolutely. We'll call it the tech wreck. That will be the best bet. So we're going to talk about technology and how to invest in it very quickly. Number one, you want to do your research to find out which technology companies you're comfortable owning for the long term. There are many names out there to consider, so make sure you find the ones that make the most sense for you, and then use a strategy called dollar cost average into them. I believe we have the next 6 to 9 months before we'll see the technology sector grab a footing and start to push higher. So we want to buy the dips. What does that mean? It means when they're down, do a little nibbling, do a little buying, but do it over a period of time. If they start to take off, well, you'll have some exposure. If it takes a while and they ebb and they flow and they just grind along, well, you'll be nibbling and buying a little bit of time. You're buying the dips. Then over a period of time, maybe the 6 to 9 months, you'll have built a complete position in the tech names and you'll be ready for the next phase when they're ready to move higher. Okay, besides the jack, real estate, the queen, commodities and gold, the king, which is cash, and the stocks, which are the ace, how about we throw in a couple wild cards? How about we talk about private investments and cryptocurrency? I believe those are the two wild cards that you also want to have in your deck for 2023. With private equity or private credit, these things called private, these are investments that may be illiquid, they may be higher risk, they may be higher return, but I believe that in this environment, private investments do matter. So make sure you talk to your investment professional or reach us at Great Lakes Wealth to find what private investments may be appropriate for you given your specific situation. Okay, the other wild card is cryptocurrency. In this case, we can look at Bitcoin, the granddaddy of them all, or you can certainly look at any of the other coins or tokens that are out there. But for this podcast, we'll talk about Bitcoin and we'll talk about cryptocurrency in general, that you can take a small amount of that pile of investment money and put it into the cryptocurrency space. We recommend no more than 5%. So maybe 1% to 5%. I believe it's extremely speculative, but it also has a huge opportunity. So again, size matters. No more than 5%. So maybe 1% to 5% max in your portfolio. This could help create some alpha, which means excess returns in your portfolio. And if things do not work with cryptocurrency and they come crashing down, having a small exposure should not hurt your overall portfolio when the other pieces of your portfolio may do exceptionally well. So in this current environment, please look at two wild cards: private investments and cryptocurrency. So what's the bottom line? The bottom line today is have your plan, not a plan, but your plan. And how about we see the forest through the trees? Look at long-term investing, not just short-term investing. Also, begin with the end in mind. Put all of your money into the 5% money market, and then from there, decide where else you can go to potentially invest for success. Real estate is the jack. Focus on cash flow. Gold, oil, and other commodities are the queen, and I believe we're in a commodities super cycle. Cash is certainly the king, and you should receive 5% or higher on your cash currently. And stocks are the aces. Remember, dividends matter. Buy the dips and do your research to make sure you have stocks that are appropriate for your investment portfolio. And last but certainly not least are the wild cards. We're talking private investments and we're talking cryptocurrency. Talk to your investment professional to see where all of these assets may fit into your investment portfolio for 2023. Well, I hope this helps you to have a great year investing and building a strong portfolio for the long term. And remember that although sometimes investing is hard, it's this volatility that creates the opportunity. And for long-term investment success, you really do want to buy low. So thanks for tuning in, and make sure to follow us on social media. Give us a subscribe, give us a like, leave a comment. And as I always say, live your best life, be radically generous. A great big booyah to ya. This has been episode 77 of the What Do We Do podcast, but we're just getting started.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.